If you own commercial or investment property, you're probably leaving 6 figures on the table, and the IRS is fine with that. Most property owners are missing out on a massive tax strategy hiding in plain sight. It's legal, it's time-tested, and it's often overlooked. I'm talking about cost segregation, a powerful method to accelerate depreciation and keep more money in your pocket, starting in year 1. Welcome to the Cost Segregation Company, where we help commercial and investment property owners unlock the hidden equity in their buildings. In this video, I'll break down the basics of cost segregation, show you how it works, give you a real-world example, and explain exactly who should be using it. If you own property and pay taxes, this could change your strategy forever. Let's start with what depreciation really means. When you buy a property, the IRS lets you write off the value of the structure over time. For residential rental property, that's 27.5 years. For commercial, it's 39 years. That means you're spreading deductions out across decades, even if you're only holding the property for 5. Cost segregation changes the game. Instead of treating the building like one big depreciating asset, we break it into components. Things like carpet, cabinets, lighting, appliances, HVAC systems, even land improvements like sidewalks or landscaping. These parts depreciate faster, 5, 7, or 15 years, meaning you can take significantly larger deductions up front. That front-loaded depreciation boosts cash flow, reduces your tax bill, and can create passive losses that offset rental income or even other income if you qualify. Let's say you purchase a $1 million building. With straight-line depreciation, you'd get around $25,000 to $35,000 per year in deductions. But with cost segregation, you might write off $250,000 to $300,000 in year 1 alone. That's not some loophole. It's IRS-approved strategy that's been in the code for decades. Here's a real example. A client of ours bought a $2 million multifamily property. With standard depreciation, they were looking at a deduction of about $51,000 per year. Not bad. But after we completed a cost segregation study, they were able to take $620,000 in deductions in year 1. That deduction wiped out their rental income tax, gave them a sizable refund, and let them reinvest in another building. Same building, same IRS, just a smarter strategy. And that's the power of compounding. When you reduce your tax liability today, you free up capital to invest tomorrow. That creates momentum. And cost seg is one of the best tools to fuel that. Now, let's clear up a few myths. First, is cost segregation just for billion-dollar REITs or mega corporations? Absolutely not. If your property is worth $500,000 or more, it's likely worth exploring. We've run studies for office buildings, warehouses, apartment complexes, self-storage, even mobile home parks. Next, do you have to pay it back? The answer, kind of, but not really. When you sell, depreciation recapture does apply, but it's taxed at a lower rate than your income, typically 25%. And even then, you're deferring that tax for years. Meanwhile, you've had the benefit of using that capital to grow your business or portfolio, the time value of money. And finally, what if you plan to 1031? Great. You can still do cost seg, still take the deductions, and still defer gains by rolling into a new property. Cost seg plus 1031 equals elite level tax strategy. At the Cost Segregation Company, we specialize in one thing: helping property owners like you reduce their taxes using cost segregation. That means engineering-based studies, IRS compliant documentation, and white glove service. Want to know how much you could save? Just visit costsegregation.net and request a free estimate. It takes 2 minutes and it could unlock 6 figures in tax savings. There's money in your walls. Let's help you find it and put it to work.